Welcome to Iron Financial. I am your lead analyst. Listen, the market out there right now, it's showing some serious cracks. We're seeing structural faults everywhere you look, but our mission here is simple. We want to help you forge a much stronger portfolio. Today, we're cutting straight through the market weakness to stress test the absolute structural integrity of a major cornerstone in the financial world. We're talking about S&P Global. We are putting their latest filings, those heavy-duty SEC Form 10Qs, and their forward-looking 2026 snapshot right on the anvil. We're going to hammer out the numbers, the revenue, the debt, the margins. We need to find out right off the bat, is this stock made of solid steel, or is it just polished tin? And I'm your co-host, the Market Skeptic. Look, it's incredibly easy to get swept up in the polished presentations, right? The corporate jargon. But I'm here representing you, the retail investor who just wants the unvarnished truth. The question we really have to ask right now is simple. Is S&P Global actually built to last, or is Wall Street just buying the hype? I mean, we've all seen massive companies with supposed solid foundations just crumble the second the macroeconomic winds change. So I am absolutely not just taking management's word for it. No way. I demand a deep dive into the real numbers. I want to see the actual underlying mechanics that are supposedly holding this behemoth together. Is this real strength, or is it just a facade? All right, let's look at the bedrock of this quarter. First quarter of 2025. S&P Global dropped a massive top-line figure. We're talking $3.77 billion in revenue. That is an 8% growth year over year. Think about that for a second. In a market environment where so many companies are literally just struggling to keep the lights on, or they're dealing with rapidly shrinking margins, S&P Global is out here doing the heavy lifting. This isn't just some arbitrary number, okay? This is pure top-line strength, and it's driven by broad-based demand across all of their reportable segments. We're looking at a foundation that is actively expanding. They are pulling in nearly $4 billion in a single quarter. That cash funds their operations, services their debt, and aggressively returns capital to shareholders. But revenue is really just the raw material. Let's look at the operating profit for Q1 2025. It came in at $1.57 billion. Okay, whoa, hold on a second. $1.57 billion in operating profit on $3.77 billion in revenue? That is a massive figure, but I really need to understand the mechanics behind this. Because look, a lot of companies can print top-line revenue, but then they just bleed out in operating expenses, especially in a high-inflation environment where labor and tech costs are just soaring. So how exactly are they forging that kind of profitability? Are they just cutting costs to the bone and starving their future growth to make the quarter look good? Or is there a real sustainable engine driving these margins? Let's not just look at the shiny output here. I want to inspect the machinery. That is exactly why we need to look at the underlying engineering. You really have to notice how an 8% revenue jump actually translated into a massive 14% operating profit surge. This right here, this is what we call margin expansion, and it's the absolute hallmark of a fundamentally sound business model. They aren't just selling more stuff, they are operating substantially more efficiently. Total expenses only increased by a mere 5%, so their top-line growth is significantly outpacing their cost structure. When a company can take a smaller revenue increase and literally engineer it into a double-digit profit surge, you know the underlying blueprint is rock solid. They're generating immense operating leverage. That means every single new dollar coming in the door is vastly more profitable than the last one. Now, let's break down the revenue mix to really prove the durability of this foundation. A massive 50% of their revenue comes directly from subscription services. This is sticky, recurring revenue. It is the reinforced concrete of their entire business model. When market volatility hits and transaction volumes dry up, that 50% provides incredible downside protection, simply because those contracts are already locked in. Then, they also have 13% in non-transaction revenue, plus 8% in asset-linked fees. So a huge portion of their incoming capital isn't even dependent on daily market swings, it's anchored. And that gives them a highly predictable, durable cash flow stream to weather almost any financial storm you throw at them. Well, let me interrupt you right there, because I'm looking at these 10Q figures, and I see a potential crack in the armor. 22% of their revenue is tied to non-subscription, transaction-based activity, right? That is a highly cyclical segment. If the broader credit markets freeze up, or if corporate M&A activity just falls off a cliff, that 22% could vanish overnight. That would leave a massive hole in their earnings. Isn't this transaction dependence a huge vulnerability? I mean, if a fifth of your building is made of glass during a heavy financial hailstorm, I'm going to be worried about the whole structure. How do they realistically defend against that kind of sudden volatility? They defend against it through extreme diversification and heavy lifting across every single division. Seriously, look at this breakdown. Mobility surged by 22%. Indices and market intelligence both climbed 16%. Commodity Insights posted a solid 13% increase. And even Ratings, which, by the way, handles a lot of those exact transactions you're so worried about, even they grew by 11%. They aren't relying on one single pillar to hold up the roof here. Every single one of these 5 divisions forged positive, double-digit, or near double-digit profit growth entirely independently. When one sector inevitably faces cyclical headwinds, the others step up to provide the necessary support. This is exactly how you build a resilient, multifaceted operation that doesn't just cave in when the macro environment shifts. And to prove it, let's literally read the tape right from their SEC Form 10-Q. Notice the operating-related expenses sitting right there at $1.15 billion, while selling and general expenses are very closely managed at $764 million. We dig into these raw, unadjusted numbers at Iron Financial because we want to uncover the actual truth. They absorbed higher internal compensation cost and still successfully delivered that 14% profit growth we just talked about. Now look over to the balance sheet. Total assets are sitting at nearly $60 billion. $60 billion. The sheer scale and magnitude of their asset base is a true testament to the heavy-duty nature of their global operations. Fine, but let's drill back into that ratings segment for a minute. They posted a $757 million operating profit there alone. If the macro environment is so tough right now, with interest rates putting serious pressure on corporate borrowing, how exactly are they pulling that off? What is genuinely driving the transaction side of this business right now? I'll tell you exactly what's driving it. Total billed issuance hit $1.083 trillion. That's a 9% jump. Even with traditional investment grade and high yield issuance down slightly, their other billed issuance skyrocketed by an impressive 27%. This was heavily fueled by a massive increase in collateralized loan obligations, CLOs, and heavy M&A activity driving bank loan ratings. The demand for rigorous credit analysis doesn't just stop when rates change. It merely shifts to different, more complex parts of the market. And S&P Global is perfectly positioned to capture that shifting volume. And if you really want to talk about bedrock strength, let's pivot over to the indices segment. We are talking about a massive 30% increase in average ETF assets under management. That brings the ending AUM for ETFs to a staggering $4.304 trillion, which translates to an 18% jump year over year. This immense volume directly drives their asset-linked fees, which surged by 18% to hit $288 million for the quarter. This is arguably the strongest load-bearing pillar in their entire portfolio. As long as continuous capital flows into passive investing and ETFs, S&P Global effortlessly takes a cut. It's an unstoppable tailwind built directly into the foundation of modern finance. Okay, let's aggressively pivot to something that feels like a massive structural alteration. In April 2025, they announced they are separating their mobility segment into a brand new publicly traded company. Now wait a second. Mobility just posted a 22% profit jump. It is essentially their fastest growing profit engine. Why on earth would you take a sledgehammer to your highest growth asset and spin it off into the unknown? Is this actually unlocking value for the shareholders, or are they effectively amputating a vital limb just to create some short-term Wall Street hype? It's absolutely not an amputation. It's precision engineering. The mobility spinoff is a highly strategic, tax-free structural reorganization. By separating mobility, S&P Global becomes a significantly leaner, more focused core business. It'll be centered purely on the global capital and commodity markets. Yes, mobility had a 22% profit jump, but it serves the automotive value chain. That is a completely different framework altogether. But you are literally losing the exact diversification you just praised 5 minutes ago. You're sacrificing a high-growth asset just to narrow your focus. You aren't losing the value at all. As a current shareholder, you receive shares in the new mobility company completely tax-free. It unlocks trapped value. It allows both independent companies to allocate their capital much more efficiently. It's about trimming the fat to reinforce the core strength of both entities going forward. Speaking of the core, let's look at the debt load holding this whole operation up. There is $11.38 billion in long-term debt sitting heavy on their balance sheet. That is a massive, undeniable liability. In an era of shifting and unpredictable interest rates, a debt pile that large can very quickly become a crushing weight on future earnings. Is this balance sheet actually made of iron, or is it made of glass, just waiting to shatter under the extreme pressure of servicing all these obligations? You simply cannot just ignore $11 billion of corporate leverage. Well, nobody is ignoring it. Let's instantly stress test that debt against their actual financial covenants. The only financial covenant required by their primary credit facility is that their indebtedness to cash flow ratio must not be greater than 4 to 1. And management explicitly states in their filings that this covenant level has never been exceeded. Furthermore, they're sitting on a highly liquid $1.46 billion in cash and cash equivalents, so they have immense liquidity ready to deploy. The debt is perfectly structured, it's highly manageable, and it's easily serviced by their massive $1.57 billion quarterly operating profit. The balance sheet is ironclad. Then because the balance sheet is so incredibly strong, management is aggressively forging shareholder value. The capital returns here are staggering. In January 2025, they confidently increased the quarterly common stock dividend to 96 cents per share. On top of that steady income stream, they executed $650 million in share repurchases in Q1 2025 alone. Think about that. Aggressive buybacks reduce the share float, basically artificially engineering higher earnings per share even in flat quarters. And they still have 10.7 million shares remaining under their massive 2022 authorization program. They are utilizing their solid foundation to heavily reward shareholders, buying back their own stock because they know exactly how durable the underlying business truly is. Now, let's fast forward a bit. Let's look at the most recent data to see how this all plays out. We just extensively reviewed the foundation laid back in 2025. Well, by Q1 2026, the company released an earnings snapshot showing that the strong 2025 foundation built a massive launchpad for incredible growth. Top-line revenue surged to an outstanding $4.17 billion exactly a year later. They didn't just maintain their prior strength, they expanded the structure entirely. That massive leap from $3.77 billion to $4.17 billion in a single year demonstrates that the business model isn't just durable, it is actively compounding its own fundamental strength year after year. Let's really hammer home the bottom line. For Q1 2026, S&P Global reported a staggering $1.4 billion in first quarter earnings. That translates directly to $4.69 per share in pure profit. Adjusted for specific one-time costs, you're looking at an impressive $4.97 per share. These numbers absolutely blew past Wall Street expectations, which were cautiously sitting around $4.82 per share. The heavy lifting and the strategic engineering they did in 2025 undeniably paved the way for massive earnings power in 2026. This is exactly what a well-oiled, perfectly engineered financial machine looks like when it's firing on all cylinders and operating at full capacity. Okay, I have to admit, looking at the 2026 forward guidance, it is incredibly hard to argue with those numbers. They are projecting full-year earnings tightly in the range of $19.40 to $19.65 per share. Even as the dedicated skeptic of this operation, I have to acknowledge the raw, undeniable upward momentum of this company's blueprint. The underlying margin expansion is clearly real, the massive debt load is being managed perfectly, and the revenue generation is actively accelerating. I mean, they're consistently beating the street's highest estimates and constantly raising the roof on their own internal projections. So, it really all comes down to the final verdict. I've aggressively pushed back on the transaction volume risks, I brought up the massive $11 billion debt pile, and the logic behind the mobility spinoff. But the verified numbers from Q1 2025 straight through to the Q1 2026 blowout are sitting right in front of us. I need the ultimate bottom line from our lead analyst right now. Is this stock a sound, foundational addition to a retail portfolio, or is it merely a highly polished value trap, just waiting to collapse under the weight of the next macroeconomic pressure test? Give us the final read. Here is the Iron Financial final blueprint. S&P Global is an absolute, undeniable powerhouse. Let's break it down. First, their underlying margin expansion consistently outpaces their revenue growth, meaning they are efficiently squeezing more and more profit out of every single dollar earned. Second, their massive 50% subscription base provides unparalleled, ironclad downside protection when the broader markets get rough. Third, the highly debated mobility spinoff isn't a loss. It actively creates a sharply focused, leaner core business while simultaneously unlocking tax-free value for existing shareholders. Finally, their unbroken 2026 trajectory is actively smashing all Wall Street estimates. The verdict is crystal clear. This is absolutely not a trap. This is a foundational, heavy-duty opportunity for any serious long-term investor. We've laid out the comprehensive blueprint. We've rigorously stress-tested the raw numbers, and S&P Global has thoroughly proven its foundational integrity. Now the question directly turns to you. Is your portfolio built with iron? Does it have the exact same recurring revenue protection, the same aggressive margin expansion, and the same unyielding strength to comfortably weather market volatility? Don't just trust the standard market hype, folks. Look closely at the actual numbers, meticulously analyze the corporate filings, and build your own solid foundation. Thanks for joining us for this explainer. Keep actively stress testing your investments, and we'll see you on the next deep dive.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.